A single line of code, buying the 10 smallest stocks in China's A-share market each month, backtests to a staggering 400-fold gain over a decade. The rationale is classic: small companies face greater business and liquidity risks, so investors demand a higher expected return. Yet this apparent edge is a trap. Factor performance is inherently cyclical. The small-cap premium can disappear for years, leading to painful drawdowns. Moreover, when a strategy becomes popular, capital inflows drive up prices of the targeted stocks, compressing future returns and setting the stage for violent reversals as traders exit. These dynamics reveal the fragility of any single-factor approach. Today, we explore why such simplistic rules inevitably break, and we follow the evolution of quantitative investing from manual factor blending to self-learning neural networks. These advanced models can identify complex patterns invisible to the human eye, but they bring their own challenges. Ultimately, success hinges not on complexity, but on disciplined validation and risk management. The small-cap anomaly is genuine but fragile. By sorting all stocks by market capitalization and buying the bottom decile each month, one exploits a structural risk premium. Smaller firms tend to be less liquid, wider bid-ask spreads and lower trading volumes, and more volatile, with limited analyst coverage, making them inherently riskier. Over one historical period, this simple rotation compounded to 400 times initial capital. However, the path was harrowing: drawdowns exceeding 40%, multi-year slumps, and nerve-wracking uncertainty tested even committed followers. When the factor gained popularity, crowded trades eroded the premium, and abrupt reversals punished latecomers. This taught a crucial lesson: relying on a single factor is like having a single point of failure. Resilience demands diversification across multiple return drivers: value, momentum, quality. Yet combining them raises a new dilemma: how do you blend these factors objectively, avoiding human biases? That question sets the stage for systematic, machine-driven solutions. In theory, a multi-factor model allocates capital across independent return drivers: cheapness, trend, safety, each contributing to a weighted expected return. But in practice, factors overlap. Small-cap stocks often appear cheap based on price-to-book, so naively averaging size and value scores double counts the same effect, leading to concentrated bets. Additionally, factor directions conflict. A low price-to-book ratio is desirable for value, while high recent returns signal momentum. Harmonizing these requires careful scaling and orientation. With dozens of factors, the number of possible weighting schemes explodes combinatorially. 10 factors with 10 discrete weight levels yield billions of combinations. Human intuition falters under this curse of dimensionality, often defaulting to ad hoc or biased blends. To navigate this, we need a systematic method that learns optimal weights directly from data, without preconceptions. Machine learning offers exactly that. It can identify the multi-factor recipe that historically maximized risk-adjusted returns, paving the way for a more disciplined, data-driven investment framework. Machine learning formulates investing as a function f, x, y, where x is a vector of factor values for each stock at each time, and y is the future return. Training iteratively adjusts the model's parameters to minimize a loss function, the gap between predictions and actual outcomes. It is akin to a student solving thousands of practice problems to infer the underlying rule. Unlike linear models, neural networks can learn intricate, conditional relationships. For instance, when market cap is below 500 million, price to book below 1.2, and turnover between 5 and 10%, the next month's win rate jumps to 70%. Such patterns arise from nonlinear interactions that manual analysis would miss. However, the loss measured on historical data is not a guarantee. A model can easily memorize noise, performing brilliantly in backtests yet crumbling in live markets. Therefore, the objective function must be paired with rigorous validation to ensure that the captured signals are genuine and not spurious artifacts of the past. If machine learning is an engine, data is its fuel. A model's ability to generalize depends on the breadth of its training examples. For China's A-shares, 3,000 stocks over a decade produce roughly 360,000 monthly observations. Multiplying by 1,000 factors, market cap, valuation ratios, volatility, analyst revisions, yields 360 million data points, a volume far beyond human cognition. To avoid the cardinal sin of mistaking memorization for insight, the dataset is split chronologically, the first 80% for training, the last 20% for testing. This mirrors studying with past exams and then facing an unseen final. Without a holdout set, a model can learn random noise specific to the training period, leading to disastrous out-of-sample performance. Data quality is equally critical. Survivorship bias, excluding delisted stocks, look-ahead bias, using future information, and unadjusted corporate actions like splits can corrupt the signal. Meticulous cleaning and alignment ensure the fuel is pure, so the engine runs on reliable information, not distortions. Linear regression remains a staple in traditional quant for good reason. It assigns each factor a coefficient, yielding a transparent weighted sum that is easy to explain to investors and regulators. Yet the financial world is rarely so straightforward. Factor relationships are often nonlinear. Value may only predict returns when momentum is not negative, for example. Neural networks, as universal function approximators, can capture such complexities by stacking layers of nonlinear transformations. The trade-off is opacity. When a deep network issues a prediction, tracing the exact logic is nearly impossible. In a domain where errors carry steep costs, interpretability has genuine value. A pragmatic approach is to deploy linear models when they suffice, but to adopt neural networks for highly nonlinear problems, provided that strict out-of-sample testing and risk constraints are enforced. This balance leverages the strengths of each methodology while mitigating their weaknesses, marrying the simplicity of linear thinking with the power of deep learning. A neural network is a cascade of transformations. Input features, a stock's valuation, momentum, and volatility, enter hidden layers. Each neuron computes a weighted sum plus a bias, then applies a nonlinear activation like ReLU. The first hidden layer might detect simple motifs, small market cap combined with low price to book. The second layer synthesizes these into higher-order abstractions, small, cheap, with accelerating momentum signals a potential breakout. The final layer outputs an expected return score. Training uses backpropagation. The prediction error is propagated backward through the network, and each weight is nudged proportionally to its contribution to the error. Over millions of iterations, this gradient descent process steadily reduces the loss, uncovering remarkably subtle predictive signatures. The network autonomously constructs a hierarchy of features, starting from raw factors and building up to complex, conditional patterns that would elude even seasoned analysts, yet all remain driven purely by historical data. Tracking the loss function during training tells a crucial story. Initially, both training and validation losses drop sharply as the model captures the broad data structure, whether linear, circular, or spiral. But with further iterations, training loss continues to fall while validation loss plateaus or even climbs. This divergence signals overfitting. The model starts memorizing idiosyncratic noise in the training set, impairing its ability to generalize to new data. In quant finance, an overfit model is a ticking time bomb. It may shine in backtests but fail when market dynamics shift subtly. To combat this, early stopping halts training once validation loss degrades, preserving the model at its peak generalization. The ideal is a model that has extracted genuine economic signal without internalizing ephemeral quirks. This delicate balance determines whether a strategy will be robust or fragile, making the learning curve a vital diagnostic in any quantitative development pipeline. Consider a dataset of points neatly separable by a straight line. In the TensorFlow playground, a minimal network, 2 layers, 2 neurons each, quickly finds a clean boundary. This mirrors financial cases where factor returns are inherently linear. For instance, the relationship between earnings yield and subsequent returns often approximates a straight line. Higher yield leads to higher returns, all else equal. In such scenarios, a linear regression or a simple neural network suffices. Adding hidden layers would be over-engineering. It raises computational demands, reduces transparency, and amplifies the risk of overfitting. The parsimony principle, Occam's razor, applies. Let the data's complexity dictate the model's complexity, not a desire for sophistication. A minimal model is easier to validate, monitor, and explain. Quantitative machine learning's first rule is to start simple and only increase complexity when there is clear evidence that nonlinear patterns in the data demand it. Now imagine a circular dataset, blue points clustered at the center, orange points forming an outer ring. A linear model cannot separate them, its decision boundary becomes a random smear. However, a network with 3 hidden layers of 3 neurons each gradually warps the feature space. After 100 iterations, it traces a rough circle, correctly classifying most points. This mirrors financial realities where relationships are conditional. A stock might be attractive only when value is cheap and momentum is positive, but not when both are at extremes, perhaps because extreme cheapness signals distress and extreme momentum signals reversal risk. Such zone-based, nonlinear interactions are common. Neural networks excel at automatically discovering these complex regions without manual rule specification. They learn the topological transformations needed to make the classes separable, providing a powerful tool for capturing the market's nuanced behavior that simpler models would overlook. The spiral dataset presents the ultimate challenge: 2 entwined arms of points that a shallow network perceives as a chaotic blur. But a deep network, 6 layers, 6 neurons each, progressively unrolls the spiral over 200 iterations. Each layer performs a nonlinear transformation, and collectively they create a new coordinate system where the originally tangled classes become linearly separable. In finance, this depth captures multi-period dependencies, volatility clustering, or abrupt regime shifts. For instance, a stock's return may depend not only on current factors but also on the trajectory of volatility over time, information that requires composing several nonlinear mappings. Depth empowers such learning, but at a cost. More parameters increase the capacity to memorize noise. Regularization techniques like L2 weight penalties or dropout are essential to keep the model focused on robust signal rather than spurious artifacts, ensuring that the deep architecture extracts enduring patterns and not fleeting eccentricities. Sometimes raw factors are insufficient. A shallow network might fail on a circular pattern, but if the input includes squares and cross-products of coordinates, it can solve the problem with far fewer layers. This is feature engineering in finance, creating new inputs like value-momentum interaction terms, volatility ratios, or earnings acceleration. It injects human domain knowledge, our understanding of market structure, into the model. For example, a volatility ratio, short-term over long-term, can indicate trend stability without the model having to learn it from scratch. However, this is a double-edged sword. Adding too many handcrafted features risks overfitting and multicollinearity, where correlated inputs destabilize the model. The art lies in engineering a small set of high-quality, orthogonal features that complement the network's innate nonlinear learning. The ideal approach blends human-crafted insights with the model's ability to discover its own representations, achieving a synergy that outperforms either method alone. Moving from a demo to live trading requires a rigorous pipeline. It starts with data collection, fetching clean, survivorship bias-free price and fundamental data, adjusting for splits and dividends, and normalizing scales. Feature engineering then transforms raw data into predictive signals, guided by domain expertise. The model is trained on historical data, with hyperparameters tuned via cross-validation to balance bias and variance. Backtesting simulates realistic trading with commissions and slippage, evaluating metrics like Sharpe ratio and maximum drawdown. Only after convincing out-of-sample performance does the model proceed to paper trading, where it runs on live data without capital, and then to actual execution with small, monitored amounts. Tools like TensorFlow, PyTorch, and Backtrader streamline this process. Yet the scarcest resource remains human judgment, assessing whether a statistical edge has a sound economic rationale or is a fleeting artifact, and constantly questioning the model's vulnerability to regime change. We have journeyed from a one-line stock screen to deep neural networks that unravel spirals. The central lesson is not that machine learning is a panacea, but that markets are inherently complex, and our tools must match that complexity while remaining on a tight leash. A simple factor can work until it doesn't, succumbing to cyclicality and crowding. A deep network can excel until it overfits, failing under new conditions. The quant's true task is to balance signal extraction with rigorous risk control, always prioritizing robustness over raw returns. When you encounter a dazzling backtest, probe its construction. How was the model validated? What are its capacity limits? What scenarios break it? These questions separate enduring strategies from ephemeral illusions. Thank you for watching this exploration. Please share your thoughts below. In your view, which quant factor is currently the most overused? Your insights enrich the conversation. Markets reward discipline, not certainty. If this analysis helped, like the video and subscribe to DeepQuant. Tell us in the comments which market idea we should test next. Evidence beats noise. Control risk before chasing returns.